There is a moment every investor faces. The market is falling. Your portfolio is down 20, 30, 40%. Every headline screams panic. Every instinct in your body tells you to sell, to stop the pain, to get out before it gets worse. And if you listen to that instinct, you will lock in a loss that may take years to recover from. The market did not beat you. Your own brain did. Today, we are going to expose the 4 psychological biases that destroy wealth under pressure. And we are going to give you a decision-making framework that works even when your emotions are screaming at you to do the wrong thing. Here is the gap that costs investors more than any market crash. The gap between knowing what to do when you are calm and actually doing it when you are terrified. When you are sitting on your couch reading about investing, everything makes sense. Buy low. Sell high. Stay the course. Ignore the noise. These principles are not complicated. But when your portfolio is down 30% and every headline is predicting a depression, those principles feel irrelevant. Your brain does not care what you read in a book. Your brain cares about survival. And survival mode makes terrible investment decisions. The gap between knowing and doing is not filled by more knowledge. It is filled by understanding exactly how your brain works under pressure, and building a system that works even when you are not thinking clearly. There are 4 psychological biases that cause almost every bad financial decision made under pressure. You have experienced every single one of them. You just did not have names for them. The first is loss aversion. The pain of losing money is psychologically twice as powerful as the pleasure of gaining the same amount. The second is recency bias. Your brain assumes whatever just happened will keep happening forever. The third is overconfidence. After a few wins, you start believing you are smarter than the market. And the fourth is herd mentality. When everyone around you is doing something, your brain interprets going along as safety. These biases are not personality flaws. They are evolutionary wiring. Your ancestors needed them to survive on the savanna. They are a disaster in the stock market. Let us expose each one. And let us learn how to override them. Bias 1. Loss aversion. In 1979, 2 psychologists named Daniel Kahneman and Amos Tversky discovered something that changed our understanding of decision-making forever. They called it loss aversion. Through extensive experiments, they proved that the psychological pain of losing $100 is roughly twice as intense as the pleasure of gaining $100. Your brain is not a rational calculator. It is a loss avoidance machine. And in the stock market, this bias is catastrophic. When your portfolio drops 20%, the pain you feel is not proportional to the loss. It is amplified. Your brain screams at you to stop the pain. And the only way to stop the pain in the moment is to sell. So you sell. The pain stops. And you lock in a loss that may never recover. This is not weakness. It is wiring. But wiring can be reworked. The first counterweapon against loss aversion is a reframe. You have not lost money until you sell. A portfolio decline is not a loss. It is a temporary price change. The companies you own are the same companies. The economy is the same economy. The only thing that has changed is the market's mood. And the market's mood has changed hundreds of times before and always recovered. Every single time. Reframing a decline as a temporary price change rather than a permanent loss reduces the emotional intensity. You are not losing money. You are watching prices fluctuate. And price fluctuations are the price of admission for long-term returns. This reframe does not eliminate the pain. But it makes it manageable. And manageable pain is pain you can sit through without selling. The second counterweapon is pre-commitment. The worst time to decide what you will do during a market crash is during a market crash. Your brain is flooded with stress hormones. Your reasoning is compromised. The time to decide is now, when you are calm. Write down your plan. Write it on a physical piece of paper. If the market drops 20%, I will buy more. I will not sell. This is the plan. Sign it. Keep it visible. When the crash comes, and it will come, you do not need to make a decision. You already made the decision. You just need to follow the plan. Pre-commitment removes the need for willpower in the moment. And removing the need for willpower is how you beat loss aversion. Bias 2. Recency bias. Recency bias is the brain's tendency to assume that whatever just happened will keep happening forever. If the market has been going up for 6 months, your brain assumes it will go up forever. If the market has been crashing for 3 months, your brain assumes it will crash forever. This bias makes evolutionary sense. If it rained yesterday, it might rain today. If a predator attacked last night, it might attack again tonight. But the stock market does not work like the savanna. The market is cyclical. Downturns are followed by recoveries. Bubbles are followed by corrections. Always. But your brain does not see cycles. It sees trends. And it extrapolates them indefinitely. This is why investors are most pessimistic at the bottom of a crash, right before the recovery, and most optimistic at the peak of a bubble, right before the crash. Recency bias makes you buy high and sell low. The exact opposite of what you should do. The cure for recency bias is absurdly simple. Zoom out. When you feel the panic rising, open a 50-year chart of the stock market. Look at every crash. 1987. The dot-com bubble. 2008. The pandemic crash of 2020. Every single one was terrifying in the moment. Every single one felt like the end of the financial world. And every single one was followed by a full recovery and new all-time highs. The market has a 100% recovery rate over history. That does not guarantee the future. But it tells you what the smart bet is. The smart bet is that this crash, like every crash before it, is temporary. Not because you are optimistic. Because you are looking at the data. And the data is unambiguous. Zooming out does not eliminate fear. But it puts fear in context. And context is what recency bias steals from you. Here is a simple rule that will save you thousands of dollars over your investing lifetime. Stop reading financial news. Financial media makes money from your attention. And the emotion that captures attention most reliably is fear. Every market decline is framed as a crisis. Every recovery is framed as fragile. The headlines are designed to trigger your recency bias, to make you feel like whatever is happening right now will last forever. It will not. Today's terrifying headline is tomorrow's forgotten panic. If you simply stopped consuming financial news, your investment returns would likely improve. Not because you know more. Because you are no longer being manipulated by people who profit from your fear. The data does not need a headline. The 50-year chart does not have a comment section. Trust the data. Ignore the noise. Bias 3. Overconfidence. Overconfidence is the bias that turns a few wins into a financial disaster. Here is how it works. You make 3 good investment decisions in a row. Maybe you bought a stock that went up. Maybe you sold before a dip. The market rewarded you. And your brain draws a dangerous conclusion. I am good at this. I understand the market. I can beat the system. You start trading more frequently. You take bigger risks. You stop diversifying because diversification is for people who do not know what they are doing. And then the market reminds you that 3 wins do not make you a genius. The 4th trade goes wrong. Then the 5th. And because you were overconfident, you had more money at risk than you should have. Overconfidence is not arrogance. It is a cognitive bias that transforms random success into perceived skill. And it is the reason most active traders underperform the market over the long term. The single best cure for overconfidence is a benchmark. Compare every investment decision you make against the simplest possible alternative, buying and holding a total market index fund. Did your stock pick beat the index? Did your market timing add value or subtract it? Most investors never do this. They remember their wins and forget their losses. But when you track every decision against a benchmark, the data tells the truth. And the truth, for the vast majority of investors, is that the index wins. Not because the index is brilliant. Because it is average. And being average, consistently, over long periods, beats being brilliant occasionally and reckless the rest of the time. Humility is the most profitable trait in investing. The benchmark forces humility. And humility keeps your overconfidence in check. The ultimate protection against overconfidence is a written investment policy statement. This is a single page that defines your rules before you are tempted to break them. What do you invest in? Index funds, not individual stocks. How often do you trade? Almost never. When do you check your portfolio? Once per quarter, not once per day. This document is not for the calm times. The calm times do not need rules. This document is for the moments when you have just had a big win and feel invincible, or a big loss and feel desperate. In those moments, you do not make a new decision. You consult the old one. The one you made when you were thinking clearly. A written investment policy is a contract with your future self. And your future self will be grateful you signed it. Bias 4. Herd mentality. Herd mentality is perhaps the most powerful of all financial biases because it hijacks your social instincts. For millions of years, being separated from the group meant death. If everyone in your tribe was running, you ran too, because there was probably a predator. That instinct kept your ancestors alive. In the stock market, it does the opposite. When everyone is buying, prices are usually near a peak. When everyone is panicking and selling, prices are usually near a bottom. The herd is not your protector. The herd is a contrarian indicator. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." That is not a clever slogan. It is a direct refutation of herd mentality. And it is one of the hardest things in the world to actually do. The counterweapon against herd mentality is a contrarian checklist. Before you make any investment decision, ask yourself 4 questions. 1. Is everyone talking about this investment? If your taxi driver, your barber, and your cousin who knows nothing about finance are all talking about the same stock, that is a warning sign, not a buying signal. 2. Am I feeling fear of missing out? FOMO is not investment analysis. It is social anxiety dressed up as financial reasoning. 3. Am I feeling panic? If the urge to sell is driven by seeing everyone else sell, that urge is suspect. 4. What would I do if I had not heard anyone else's opinion? This is the most important question. It isolates your own reasoning from the noise of the crowd. The checklist does not tell you what to do. It tells you when to stop and think. And in investing, stopping to think is often the most profitable action of all. Let us review the 4 biases and their counterweapons. Loss aversion. The pain of losing is twice as powerful as the pleasure of gaining. Reframe declines as temporary and pre-commit to buying during crashes. Recency bias. Your brain thinks whatever just happened will last forever. Zoom out to 50-year charts and stop reading financial news. Overconfidence. A few wins make you think you are a genius. Benchmark yourself against a simple index fund and write an investment policy statement. Herd mentality. The crowd feels safe but is usually wrong at extremes. Use the Contrarian Checklist and isolate your own reasoning. These 4 counterweapons form a toolkit. And the toolkit has one purpose: to protect you from yourself. The market will crash again. It always does. The question is not whether you will face fear. The question is whether you will have a system in place when you do. The real risk in investing is not the market. The market recovers. The real risk is your own brain, unexamined, reacting to fear in the dark. But now you have a flashlight. You know the biases. You have the counterweapons. The next time the market panics, you will not. This is the Wealth Site. If this framework gave you clarity, subscribe and turn on notifications. We release new insights regularly. Thank you for watching.